Hi everyone, this is Chapter 8 Bond Valuation prepared by Group 2. In financial market, investors will always try to earn a return that can fully compensate them for the risk taken. In the case of bondholder, real rates of return, expected inflation premium and risk premium will be taken into consideration while calculating for bondholders' required rate of return. In bond market, different segments will have different interest rate. The interest rate differentials are known as yield spread. These are the factors that cause yield spread. First of all, tax-exempt feature. Municipal bond is a kind of security issued on behalf of US government. This kind of bond usually will pay lower rates compared to corporate bonds because of the tax-exempt feature. Secondly is type of sector. In municipal sector, revenue bond will pay higher rates compared to general obligation bond, while in taxable sector, the higher the risk, the higher the yield. Treasury security that has least risk will get the lowest return, followed by agency bond, and the last one is corporate bond. The following factor is bond rating. The lower the ratings, the higher the yield. Next is maturity. Bond with long maturity provide higher yields than the short ones. And call feature. Bonds that are freely callable generally will pay higher rates than the other bond. Variables that cause interest rate to move. Inflation is the major determinant of interest rate. In general, as inflation drifts up, so does interest rate. From the graph, we can see that the interest rate of a 10-year treasury bond exceeds the inflation rates most of the time. While we can also notice that there are certain times the interest rate will fall below inflation rate, such as in the 1970s. This indicates that the 10-year treasury bond did not earn enough interest to keep up with the inflation. Other than inflation, there are other economics variables that also affect interest rate. First, change in money supply. When money supply in market increase means that there will be more funds available for loan. The exit of money supply will drive the interest rate to go down. Secondly, the size of federal budget deficit. When government is facing deficit, it will increase demand for funds, therefore drive interest rate to go up. Other than that is level of economic activity. Expansion of economic activity will drive interest rate to go up because businesses will need more funds to build their capital. Next is policy of Federal Reserve. When Federal want to control or slow down inflation, they will take action to drive up the interest rate. On the other hand, decrease the interest rate to stimulate economy when there's a deflation. Last, level of interest rate in major foreign market. In order to keep up the pace with overseas investment opportunity, the rising rate in major foreign market pressure interest rate to go up as well. Term structure of interest rate represent the relationship between interest rate and time to maturity for similar risk security. This type of relationship can be shown in a form of graph. This graph is known as yield curve, just like the one on the right hand side. And there are two types of yield curve. One is upward sloping curve and the other one is downward sloping curve. So in this chapter, we will learn about three theories to explain on the term structure of interest rate. The first theory is expectation hypothesis. According to expectation hypothesis, yield curve can reflect investor expectation about future behavior of interest rate. It involves two elements, which are today's short-term and long-term rates and expectation on changes of interest rate in future. When long-term bond has higher rates compared to short-term bond, the yield curve will slope upward. This indicates that investors expect the rate of short-term bond to rise. To have better understanding, let's look at an example. In this example, we will look at two investments. One is a 2-year note that represents longer-term security, and another one is a 1-year T-bill that represents short-term security. In this year, the rate of return of 2-year notes is 6%, which is higher than the 1-year T-bill that only get 5% return. We know that when longer-term securities earn higher rates than short-term security, the yield curve will slope upward. And according to expectation hypothesis theory, investors will expect the short-term rates to increase in future. In this example, the short-term investor will invest in another T-bill in year 2, and the investor will expect the rate return is higher than the 2-year note, which is 7%, so that the total return over 2 years for these two investments are the same at 12%. The second theory is liquidity preference theory. According to this theory, long-term bonds should pay higher rates compared to short-term bonds because there is the existence of risk differential between these bonds. The risk differentials exist mainly is because long-term bond needed to be held for a longer period, therefore it is less liquid compared to short-term bond, and also long-term bond has high price volatility compared to short-term bond. Therefore, in order to attract investors to invest in longer-term bond, they will pay high interest. The following one is market segmentation theory. According to this theory, the market for debt is segmented on the basis of preference of different financial institutions and investors, meaning that supply and demand for funds in the market is the factor that determine the movement of interest rate and cause the yield curve to change. Market segmentation theory explains that situations like the supply of short-term bond exceed the demand of short-term bond or demand of long-term bond exceeds supply of long-term bond will affect the short-term rates to become relatively low, therefore causing the yield to slope upward. Next, we will talk on how to use yield curve in our investment decision. We can observe and interpret the graph in two ways. One is through the movement and another one is through the steepness. When a yield curve begins to move upward, it usually indicates that inflation is starting to heat up. So we can expect the rates to grow higher in future. Therefore, for now, we will invest in short-term bond only. In contrast, a downward sloping curve means that the rates have already peaked and about to fall. To secure our return, we will choose to invest in long-term bond today. Next is steepness of curve. A steep curve represents the long-term rate is much higher than the short-term rate. This generally can be viewed as a bullish sign, while a flatter curve means that the yield difference between long-term and short-term bond is very small. Therefore, it is better for us to invest in shorter-term bond because they generate the same income but with lower risk.
Next, I will explain about pricing of bonds. Bonds are priced according to the present value of their future cash flow streams. Bond price equal to present value of the annuity of annual interest income plus present value of the bond par value, and this is the formula. Market yield largely determine bond price. This is because in marketplace, investors first decide what yield is appropriate for a particular bond, given its risk, and they use that yield to find the bond price. Appropriate yield at which the bond should sit is determined before price of the bond. Required rate of return is determined by market, economic, and issuer characteristics. Required rate of return becomes the bond market yield, and market yield becomes the discount rate that is used to value the bond. Next, compounding refers to frequency coupons are paid. There are two ways of compounding, which are annual compounding and semi-annual compounding. Annual compounding is coupons paid once per year, and semi-annual compounding is coupon paid every 6 months. Accrued interest is the amount of the interest earned on the bond since the last coupon payment. For example, assume a bond has a fixed coupon that is to be paid semi-annually on June 1 and December 1 every year. If a bondholder sells this bond on October 1, the buyer receives the full coupon payment on the next coupon date scheduled for December 1. In this case, the buyer must pay the seller the interest accrued from June 1 to October 1. Generally, the price of a bond includes the accrued interest. This price is called the full or dirty price.
Okay, next we will see the measures of yield and return in our chapter bond valuation. So the first one is current yield. Current yield is the simplest bond measures, which is we use very limited application. It indicates the amount of current income a bond provides relative to its prevailing market price. So how much do we get now uh, after we issue the bond? The current yield, examine the current price of a bond rather than looking at its face value. So we can take a look at the formula. Current yield equals to annual interest income divided by current market price of the bond. So we have to stress that the annual interest income, which is not monthly or not quarterly but is yearly, annual, and then divided by current market price of the bond. We want to see how much we get now for the for the market price of the bond. So we take a look at the example. 1 million ringgit bond with 8% coupon rate and currently selling at 700,000 ringgit has a current yield of, so the current market price of the bond is 700,000 ringgit, while the annual interest income, which is 8%, we have to times with 1 million ringgit bond, so we get 800,000 and then divided by 700,000 we will get 11.43%. So the next one we are going to see yield to maturity. So yield to maturity, it measures how much it will earn over its life for the investment. So it evaluates bonds interest income, evaluates any gain or loss that results from differences between price paid for a bond and par value received at maturity. The total return anticipated on a bond if the bond is held until it matures. So how much do we will get if the bond matures, after the bond matures. And yield to maturity also calculates the value based on present value of interest received and the appreciation of the bond it held if held until maturity. So the formula is annual interest plus par value minus by market price divided by number of years to maturity. So number of years to maturity equals that the number of years that it takes to mature after the bond is issued, and then that divided by par value plus market price divided by 2. So the example is a bond's market price is $1,100. It has $1,000 par value, will mature in 5 years and pays interest 10% annually. What is right here? So after we substitute all in the formula, we will get 7.62%. So you can try this exercise or example. We could also calculate YTM using the trial and error method. It is to get true YTM. So just now we got 7.62%, right? So we just use estimation. Maybe the YTM is in between 7% to 8%. So we just have to find the market price of the bond if YTM equals to 7% and if YTM equals to 8%, and then we just use integration and then finally calculate YTM using the formula given. So we will get the true YTM, which is 7.533%. You can also take a look in YouTube for the formula or the how does the YTM is get using the trial and error method. So the next one is zero coupon bonds. Zero coupon bonds means there is no coupon interest payments, which is the coupon rate is zero, and the bondholder's return is determined entirely by the price discount. So we can use the present value formula here. As you can see, suppose you pay $508 for a zero coupon bond that has 10 years left to maturity. What is your yield to maturity? So the present value equals to future value divided by 1 plus interest rate power of the number of years left to maturity. So finally we get 7%. Then we go to yield to call. Yield to call refers to the return a bondholder receives if the bond is held until the call date, which occurs sometimes before it reaches maturity. So the call date is here when issuer of a bond calls the bond before it matures, before it reaches maturity. So the date is called call date. So callable bonds give rights to issuers to retire the bond before maturity. So the yield to call formula is a little bit similar to the yield to maturity, but we just substitute the par value with the call price and the number of years to call. We substitute number of years to maturity. We substitute to number of years to call. So the formula is quite similar. So the next one is expected return. So expected return is the profit or loss an investor anticipate of on an investment that has known or anticipated rates of return. Rate of return investor can expect to earn by holding a bond over a period of time that's less than the life of the issue. So it is quite similar to yield to maturity, but actually yield to maturity is the formula that used to measure how much an investment will earn over its life. But for the expected rate of return, it refers to the interest rate that is necessary to get investors interested in the bond, which means the investors will be interested to take the bond if the expected return is good. So this is calculated to give a find a good information for the investors. So finally we are going to see the valuation of bond. So the value of the bond equals to the present value of the bond, which is future interest plus by the par value. Three essential elements in bond valuation is that the first one is the amount and timing of the cash flows, which is the future interest and the par value. The second one is time to maturity of the bond, so number of years to maturity, for example, given. And then finally, the investors required rate of return. And that's all. Thank you.
Bond duration is a measure of bond price volatility. It captures both price and reinvestment risk, which is used to indicate how a bond will react in different interest rates. It measures the average time taken for an investor to be repaid the bond's price by the bond total cash flow. It is an improvement over yield to maturity because yield to maturity does not take into account the effects of reinvestment risk and price or market risk. It also helps the investor to understand and compare the sensitivity of the bond price to the changes in the interest rates. This is because as long as the market does not experience wide swings in interest rates, bond duration can be used as a variable predictor of bond price volatility. As the interest rate change, bond price will change in a non-linear or convex fashion. This means that when interest rates fall, bond price will rise a bit faster than the bond duration will predict. And when the interest rate rise, the bond price will fall at a slightly lower rate than the bond duration will predict. In general, bond duration possesses the following properties, which is bonds with higher coupon rates will result in shorter durations, bonds with longer maturities will have longer durations, and bonds with higher yields will lead to a shorter durations. Bonds that pay higher coupons will have greater reinvestment risk. As the interest rates move, the price of the bond with longer maturities will fluctuate more as compared with the shorter issue. Bond duration and volatility are directly related. Therefore, the shorter the duration, the less volatile the bond price and vice versa. Bond duration is often confused with bonds term to maturity because they are both measures in years. However, bonds term is a linear measure of years until the repayment of the principal is due. On the other hand, bond duration is the measure of sensitivity of bond price changes in the interest rates. In general, the higher the bond duration, the more the bond price will drop as interest rates rise due to the greater the interest rate risk. Duration is a measure of the average maturity of a fixed income security. You can think of duration as the weighted average life of a bond, where the weights are the fraction of the bond's total value accounted by each cash payment that the bond makes over its life. Macaulay duration: find the present value of a bond's future coupon payments and maturity value. There are four simple steps to calculate the bond duration. Step 1. Find the present value of each annual coupon or principal payment using the prevailing yield to maturity on the bond as the discount rate. Step 2. Divide this present value by the current market price of the bond. This is the weight or the fraction of the bond's total value accounted by each individual payment. Because the bond's value is just the sum of the present values of cash payments, these weights must sum to 1. Step 3. Multiply this weight by the year in which cash flow is to be received. Step 4. Repeat steps 1 through 3 for each year in life of bond, then add up the values computed in step 3. Based on table 11.1, column 3 is the outcome of step 2, column 4 is the outcome of step 3, and column 5 is the outcome of step 4. By adding up all the values in column 5 is the duration of the bond.
and we can see that the duration of this bond is lesser than its maturity. However, keep in mind that the duration of this bond will change over time as its yield and term to maturity changes. Another way of calculating bond duration is through modified duration. The modified duration of a bond helps investors to understand how much a bond's price will rise or fall if the yield to maturity rises or falls by 1%. To find the modified duration, we can take the Macaulay duration for a bond and divide it by the bond's yield to maturity. Based on the example in Table 11.1, given that its Macaulay duration is 9.36 years with yield of 8%, the modified duration is 8.67. This means that any increase in yield by 1%, the bond's value will fall by 8.67 and vice versa. Immunization is a strategy to derive a specific rate of return regardless of what happens to the market interest rates over a holding period. Bond immunization is an investment strategy used to minimize the interest rate risk of bond investment by adjusting the portfolio duration to match the investor's investment time horizon. It seeks to offset the opposite changes in bond valuation caused by price effects and reinvestment effects. When the average duration of portfolio is equal to the investment horizon, the counteracting of price effects and reinvestment effects will offset each other. Based on Table 11.2, we assume that a bond with 8% coupon is purchased at par with a duration of 8 years. It further assumes that the market interest rates fall from 8% to 6% at the end of 5th year. Because of the investment horizon is exactly 8 years and is desired to lock an interest rate of 8% regardless any changes in the interim. Thus, it is expected to receive $1,850.93. With the immunization strategy projected in Table 11.2 had netted a total of $1,850.33, which is 60 cents different from the expected return. This is because when the rate declined at year 5, 6, and 7, the reinvestment opportunities are lower, but it led to a higher market price for the bond, and the higher price had provided capital gain to offset the loss in reinvestment income.
Next, I will continue for bond investment strategies. Bond investment strategies normally can be categorized into two approaches, conservative and aggressive. The main goal of conservative approach is to maximize current income, which usually have a longer bond holding period. On the other hand, the main goal of aggressive approach is to maximize capital gains, often with a shorter bond holding period. Furthermore, we will look into passive strategies, which are buy and hold and bond ladder strategy. Passive investment strategies are characterized into a lack of input regarding investors' expectations of the changes in interest rates or bond prices. Firstly, buy and hold strategy replaces bonds when it matures or when the quality declines. This strategy restricts the investor's ability to earn above average returns. However, it helps them to minimize losses for transaction costs. Second, bond ladder strategy is a multi-maturity investment strategy that diversifies bond holdings within a portfolio. Investors usually set up a ladder by investing equal amounts into different maturity dates. For example, 3, 5, 7, and 10 year. As bonds mature, investors will purchase new bonds, for instance, a 10-year maturity bond to keep the ladder growing. Lastly, bond swaps occur when investor sells one bond and simultaneously buys another bond in its place. There are two types of bond swaps, which are yield pickup swap and tax swap. Firstly, yield pickup swap sells a lower yielding bond and replaces it with a comparable better quality bond with higher yield. For example, suppose you sold a 20-year A-rated 6.5% interest bond and replaced with an equal amount of 20-year A-rated 7% interest bond. By executing the swap, current yield will increase as interest income will increase from 65 ringgit a year to 70 ringgit a year. And for tax swap, investors sell a bond that has declined in value and use the capital loss to offset other capital gains, while repurchase another bond of comparable better quality.
I will continue our presentation with the last part, which is the news part. The first news is ASEAN Development Bank (ADB) said that global economies are expected to post losses of US 8.8 trillion due to COVID-19. Global economies are expected to register losses between US 5.8 trillion and US 8.8 trillion. These expected losses are equivalent to 6.4% to 9.7% of global gross domestic product (GDP) following the COVID-19, according to the new report issued by the ASEAN Development Bank, equivalent to 6.4% to 9.7% of global gross domestic product following the COVID-19, according to the new report issued by ASEAN Development Bank. The next one is evaluation reports are update on the potential economic impact of COVID-19 found economic losses in Asia and the Pacific about US 1.7 trillion under a short preventive scenario for 3 months to US 2.5 trillion under a 6 months long prevention scenario. Has 3 ways that government do for impact of pandemic. First one is fiscal and monetary measures. The second one is improving health expenses. And the third one is direct support to sustain income reduction and earnings. Chief Economist of ADB, Yasuyuki Samada, in statement said, continuous efforts from the government focusing on these measures to reduce economic impact from COVID-19 by 30% to 40%. This could reduce the global economic loss following the US 4.1 trillion and US 5.4 trillion. The last one is border closure, travel restrictions and mobility restrictions undertaken by the affected countries following the decision to decide the COVID-19 chain is expected to reduce global trade of US 1.7 trillion to US 2.6 trillion. Government needs to manage supply chain interruptions, support and enhance e-commerce and logistics for delivery of goods and service delivery, and finance measures of temporary social protection, unemployment subsidies and essential commodity distribution, especially food, to prevent significant deterioration of usage. The second news is first quarter of economic growth was sharply shrinking due to COVID-19. The first quarter of economic growth in Malaysia has decreased to 0.7% compared to previous quarter, which recorded 4.5%. According to the governor of the State Bank, the economy of Malaysia is in line with other countries that implement movement control order. The inflation of the first quarter, which is 0.9%, is contributed by the implementation of sales and service tax (SST). Meanwhile, Malaysian ringgit has declined until 4.9% compared to US dollar in the first quarter due to non-resident trade outflow, which cost 26.2 billion of Malaysian ringgit. Lastly, the Bank of State predicts that economic growth will gradually recover by the second half of year 2020.